Hi, I'm Roshan Sequera. In this video, I will be explaining the basics of order flow trading and analysis, how the order flow data is plotted on the chart using the footprint or cluster charts, and some of the basic terms that are used in the order flow analysis. Let's first understand what order flow is. Order flow is a technique that analyzes the behavior or intentions of the aggressive buyers and sellers. For any trade to take place, aggressive buyer must buy at the best available offer or aggressive seller must sell at the best available bid. Without aggressive buyers or sellers, there cannot be a trade, as the passive buyers or sellers who place the limit orders cannot move the market. This makes order flow analysis very interesting as we get to know the intentions of aggressive buyers and sellers in order to make a quick trading decision. In a regular candlestick or bar chart, we only get to see the price movement with total volume. In footprint or cluster charts that we use for order flow analysis gives us detailed information on who initiates these trades, at what price levels, and what is the quantity traded at each price level. Big institutional traders can always hide the price that they're buying or selling using different strategies by slicing the order into smaller quantities. However, what they can't hide is the quantity they are trading. Order flow analysis helps us in knowing who is initiating these trades, thus tilting the balance between buyers and sellers. Who are the aggressive buyers and sellers? Let us look at the time and sales window, which shows the up and down ticks. Aggressive buyers are those who bought at the best available price, resulting in an uptick, and aggressive sellers are those who sold at the best available bid price, resulting in a downtick. Their action decides the price changes. Quantity traded by the aggressive sellers at each price levels in an interval is plotted on the left side of the cluster charts. Similarly, quantity traded by the aggressive buyers at each price level in an interval is plotted on the right side of the cluster charts. Delta volume or delta is the difference between the trades initiated by the aggressive buyers and trade initiated by the aggressive sellers. If the volume initiated by the aggressive buyers is more than the volume initiated by the aggressive sellers, then the delta is positive. If the volume initiated by the aggressive sellers is more than the volume initiated by the aggressive buyers, then the delta is negative. This information is quite crucial as we get to know who is in control of the market in a given interval. If you see the highlighted bar, the total volume traded in this interval is 3022 lots, out of which 1238 lots are traded by the aggressive buyers and 1784 lots are traded by aggressive sellers, resulting in a negative delta of 546 lots. Large delta in an interval clearly shows who is in control of the market. As you can see in the three subsequent intervals, the market continued to slide lower with more sellers present at each interval. At some occasions, you will notice the positive candle with a negative delta or negative candle with a positive delta, indicating a delta divergence. We often see this divergence when the market is consolidating after a big move, with small delta values with very little movement. Sometimes delta divergence can happen at the highs or lows of the day, with the high delta volume indicating a possible reversal of a trend. Cumulative delta is the sum of delta volume for a given period. This can be plotted from the start of the trading session or for a given period. Cumulative delta helps us in identifying the extent of buying or selling that has taken place in a trading session. For better visualization, we often use the candlestick chart as it clearly shows the large addition of aggressive buying or selling. Point of control is a price or a zone in a bar where most volume occur. This is also known as commitment of traders or COT. In this example, POCs are highlighted in yellow color. In an uptrend, we notice formation of higher point of controls at every interval. Similarly, in a downtrend, lower point of controls are formed. Buying imbalance occurs when aggressive buyers outnumber the aggressive sellers, and selling imbalance occurs when aggressive sellers outnumber the aggressive buyers. Typically, a ratio of 300% or more is considered when the market is in imbalance. This information is calculated using the volume traded diagonally, as you can see in the example. Buying imbalances are highlighted in green and selling imbalances are highlighted in red for easy visualization. Stacked imbalances occur when there are more than 3 buying or selling imbalances. More often, these stacked imbalances indicate a new trend and also act as a strong support or resistance levels. If a stacked buying imbalance occurs after forming a low, this can be a potential reversal of the trend, and the market is likely to go higher. Any corrections closer to the buying imbalance levels can act as a strong support. Similarly, stacked selling imbalances often trigger a sell-off. Any pullbacks closer to the imbalance zone is considered as a strong resistance. Trading strategies based on stacked imbalances can be quite rewarding considering they come with a minimum risk. For an intraday trader, learning order flow analysis will give immense advantage, which has been seen in this example. To sum up, this is how a typical order flow trading day looks like. Isn't this interesting? So join me at the FinBridge Traders Conference on April 30th and May 1st, 2022 to know more about order flow analysis, as I will be discussing the trading strategies and setups.